What's up, traders? Welcome. Good morning to everyone. I don't know why this camera quality. I feel like this camera quality should be better. I hope everyone's doing well, and a lot of economic data has been talked about and spilled out yesterday and today. Yesterday, we got this massive dump in the S&P into the end of the day on rumored, if you will, CPI release numbers, which were expected to, well, based on an economist point of view, were expected to see an 8.3 core CPI number, right? For the main CPI number. That was a consensus amongst a lot of economists, right? 8.3%, which would be a cooling from the 8.5 peak seen in March. But realistically, what was kind of leaked yesterday was that we'd see a number close to 8.5, something that was really big. And then into the last hour of the session, we had this massive drop that broke the key level on the S&P at that 4070, where there was a lot of trapped bids, right? And then we got this massive dump, and we're now down 100 points from that break, right? Probably even more at this point. I haven't checked it in a while, but I think we're trading around the 39.50s because this morning we got a huge miss, I guess, in a sense, right? The CPI data was in fact 8.6% year over year as the core main number, or sorry, the main number it was at 8.6% compared to the 8.3%, which is a way above the expectation. So the point here being is that there was a lot of talk about what was it, CPI and inflation actually cooling off, right? Cooling off over the past few months. Now this is the May data. So June, as in June, we'll see in July. But there was a lot of talks about it cooling off while oil was just continuously breaking higher and higher, right? Oil was just trucking along really aggressively. And again, when oil prices increase, right, inflation is going to continue to hold out at least, right? Continue to increase. So massive inflation fears. We saw the ECB yesterday talk about it. ECB numbers were in the 8 range as well. They said that they were going to go from negative rates into positive territory, 125 bips expected by the end of the year. So they're really concerned about that too. Now, one of the interesting aspects about this is that Janet Yellen actually, I don't know if this was like supposed to be like to soften the blow. I think it was realistically because she mentioned that there was no indication of a recessionary environment, which is nuts, right? She said inflation was transitory last time around. Now there's no indication of a recessionary environment. So I don't know if she's trying to like cool things down in the market, but it seems wrong because we're coming into an area of quantitative tightening. Inflation's like extremely high. And we're setting up for more hikes, right? 50 basis point hikes set up for September now. That likelihood has increased drastically. If you go to a website here, I think it's FOMC, countdown to FOMC, CME, FedWatch. So if you just type in like FedWatch futures or countdown to FOMC, you'll get the probabilities of the rate range for each of the months, right? So currently we have the current rate is between 75 and 100 bips, right? So the expected for June 15th, which is next week, is going to be a very important event, is 95% to be within 125 and 150 bips, right? So there's a 95% chance that they're going to double hike. There is a 5% chance that they're going to triple hike. And then in July, we have a solid consensus of having, sorry, let me just see what this was. We have a pretty high consensus of having another 50 basis point hike in July, right? 67%, and a potential 30% triple hike in July. September, right? They continue with these massive hikes. By the end of the year, if I'm looking at the December probability, the highest probability is that we're going to be in the range of 300 to 325 basis points. So when these hikes continue, based on all these inflation fears, right, and quantitative tightening, there's really a lot of potential downside in this market. Now, there's a lot of people that have been calling bottoms on this last rally, which I just don't think makes any sense realistically, because you have too much macroeconomic data. You still have outflows in a lot of sectors, and energy. You have to keep an eye on energy because energy is going to be the last thing to kind of capitulate and actually dump. So with energy continuing to rise, you're going to see inflation continuously either stay at a high or just continuously rise. And when that actually all crumbles and tumbles, right, that is when you can start looking for bottoms. So realistically, Multiple hikes are set out based on this report. Things are not getting cheaper. I was even on a call with one of my friends in Eastern Europe yesterday in the morning, and yeah, like prices even in Toronto and like the US obviously have increased, but he was telling me that like groceries are two times more expensive and a lot of things because remember Russia cut Bulgaria off in terms of their gas, right? So there's a lot of increases in pricing there and wages are pretty low in that part of the world. So it's affecting a lot of things, not just what we think with like gas and like gas prices, but like even around the world, right? Even here, like I've noticed like 40% increase um in grocery bills and like parts of Europe, you got double. Like that's actually insane. So until there's cooling in the actual um oil prices in that case, that I don't think there's gonna be a quote unquote bottom, right? Like there's still a lot of macro events that are kind of piling on top of one another to dictate that there's more downside, right? In the US, for example, the average price at a pump surpassed $5 a gallon. I don't even know what a gallon is to be honest, but what is that, like three and something liters? So they surpassed $5 a gallon, right? According to Gas Buddy, an industry consultant that surveys over 150,000 stations throughout the US, and the average AAA is also likely to reach that level this weekend. So prices stand around just under $5 a gallon as of today. And this is like all you've seen all these energy stocks do well. I don't recall like I honestly don't remember the last time I looked at the order flow for the energy sector when I was doing a sector by sector analysis and comparison to see which sectors are actually getting inflows and outflows. I don't recall a week where energy was not the highest inflow, right? If you go to like unusual whales, if you go to whatever like ETF.com, you type in the XLE or unusual whales, you can take a look at the sector comparison. You can see the sector rotation there, and you can see the inflows based on call or put volume on each sector. So energy is consistently staying at the top, right? XOM has done really well. CVX has done really well. And there's no real sign of slowing in that regard, right? Until you start seeing real outflows out of energy, it's just it, it's going to be here to stay at this point. So I don't really understand why Janet Yellen was talking about a call or what did she say? There was no indication of a recessionary environment in play. I don't think she believes herself, but I don't think that she should say otherwise in case there was even more fear in the market. But the reality of the situation is that we're back below 4,000 here on the ES. The potential is to break the lows under that 3,800. The lower end of the move, right, for me is around like 32 to 34. I think like 35, 36 could have a stalling, but there's still a long way to go. Again, we have overvaluations based on asset inflation over the last like 2 years, right? You're seeing names that are trading way more than their earnings, right? PE ratios are off the charts. A lot of them have cooled off, especially in tech, but there's still a long way to go. Now you're seeing consumer staples PEs super aggressive, right? In a real market drop in a recessionary environment, everything is going to get dumped. So until the P's regulate on XLPs, until the P's regulate on energy, right, you're not going to see that bottom from a macro perspective. So trying to call the bottom is really, really hard, but starting to see the upside, even if you're 5-10% off the lows, it's a little easier. So with that being said, it is Friday in the options room. We got Lotto Friday, massive dump. We're long some volatility, which is great. Yesterday we had a nice break from the 70s in the futures, and today, let me just take a look at this chart. Just keep in mind the 3950 area. The 3950 area, I don't know if it's already broken or not, but you take a look at the 3950 area, that is one of the areas that we have to hold. Otherwise, we start really accepting within a bottom, within that lower end of the distribution, right? You start breaking the 50s, and then under the 40s, 3940s, that's a huge area where we have this massive distribution, like a big balance, like we saw over the past like 2 weeks here, but to the downside. So when you enter into something like that, price wants to stay and gravitate within that. So that's something to watch out for today. I don't really see markets trying to catch a bid until we get above like 390 or sorry 3985 or so, right? That could be the first area where they look to catch a bid. Otherwise, it's going to be very difficult for this thing. We'll see what the big money does, right? There's a lot of people that play off the open. So again, we saw a lot of go and check us out on Twitter. TradePro Academy Twitter. We saw a lot of outflows coming in early in the week in big tech, right? Leading up to this massive drop. So that could have dictated something. We saw volatility was super cheap based on some readings. We posted that as well. And check out our masterclass for options and futures where we talk about all of this stuff. So I hope you guys enjoy the day. Enough of me spamming about random things. Enjoy the weekend, and we'll see you guys on the other side. So let's get ready for this trading room, and take care, everyone. How do I stop this? Thank you all. Oh, I see George is watching this. Yeah, thanks. Porn stash by night. All right, I'll see you guys.